This lesson is part of the price action series and it's going to introduce you to the concept of gaps. So, first things first, gaps have many names that you might see different traders refer to them as. They all mean the same thing, but you might hear them called inefficiencies, imbalances, gaps themselves, or even FVG, fair value gap. I'll explain what they all mean separately. But essentially, certainly the way I trade and the way I teach, they all mean the same thing pretty much. What it means is price moved suddenly and it left a high probability area for a retest. So on the schematic you can see, the reason people call it inefficiency is for this purpose. Price normally wants to move in an efficient manner. That means if it moves down, it generally bounces up to retest the previous level. Then if it continues down, before it will continue to go down again, it should retest the previous level. And then it goes down and it retests the previous level. So this, a very textbook downtrend, as you might see, will be called efficient. So it's moving efficiently. Essentially what it means is it's breaking down, retesting, breaking down, retesting, breaking down, retesting. Lower highs and lower lows all the way. Then, all of a sudden, price moves an extended amount and on the bounce is unable to retest the previous low, swing low, before the breakdown. It then goes lower, continues to downtrend in an efficient manner, but the part in the middle here that is left is known as an inefficiency or a gap. So that's why you might hear it called inefficiency. Why might you hear it called imbalance? Well, for much the same reason. As price is moving here in an efficient manner, you can categorize it or characterize it as being in balance. So it's a balanced market. It's just another word for efficient, really. It's a market that's moving as it should. You then get a sudden move in one direction, which imbalances the market, and that's why you might hear people call it that. Obviously, the word gap is self-explanatory, and I will go through exactly what it is in a moment. And then FVG, this is a term that's been popularized by Forex traders to represent fair value gap. There is a slight difference in a fair value gap, it's just a bit more specific than a regular gap, and I'll touch on that in the next slide. So why do gaps occur? The simplest reason why a gap occurs is when buying or selling pressure is significant, which results in a large up or down move that leaves behind an imbalance, inefficiency gap in the market. Okay? Fundamentally, buying or selling pressure is so significant that the market moves away in one direction without a retest. That's it. Now, actual causes for that could be sudden repricing due to new information. So, as the market's moving down in this instance, we have all available information and the market's moving as it should. Very suddenly there could be information. Let's say it's a particular coin and maybe there's some news about a hack. So there was a hack on the protocol. That's new information that was not available when price was doing all of this efficient moves. The sudden news causes a sudden move as traders react to the new information, and often they overreact and it causes the imbalance, the inefficiency, the gap. And or it can be caused by liquidations. So often you'll have both. New information will come out and it will catalyze the first part of a move, which then, because crypto is a leverage-driven market, you get a cascade of stop losses getting hit and liquidation levels reaching that causes price to move in one direction, this case down, with no opportunity to bounce. You can see that, and if you want to visualize how liquidations work, it's a domino effect. So it starts off with the bad news or whatever, it breaks through a level which starts to trigger liquidations, and as those liquidations trigger, they push the market down, which triggers more liquidations, which pushes the market down, which triggers more and more and more, hence the domino effect. So why do gaps matter and why are they good to trade into? The main reason, is that whatever causes the gap in the first place is a temporary factor, okay? Now that's time frame specific, but whatever time frame you're trading on, what causes the gap is usually a temporary factor. And so once that factor has been accounted for by the market and the market's able to reprice, we often go back to test them. Let me stick with that same example. Let's imagine price was here. You then get the news about a hacked crypto protocol. People panic to sell, which breaks it below this low. Then the liquidations occur, which causes the domino effect, which brings us all the way down here until we finally find support. And then it bounces up, bounces down, bounces up. And at this point, the move that caused the gap has been fully accounted for. So whoever was going to get liquidated, got liquidated. Whoever was going to panic, panicked. Maybe by now we know what resolution there is out of the hack protocol, whatever. But the more time that passes, the more the market can react and price that event correctly. So if and when price starts to rise, this gap becomes a high probability area for a retest. So you allow the temporary factor to happen, and once it's accounted for, we go back to test it. So that is what gaps are. Now, how do you actually draw them yourself on the chart? Well, I'm going to explain both the gaps now and the FVG, the slight variation on it. So in the shaded yellow is what I would class as, and how I teach, Again, some of it's subjective, but this is what I see as a gap. A gap is the area between the last two candles which are opposite to the trend. So the trend is up. I think that's very clear here. You have an impulse move higher. You then allow some consolidation to happen and price is all the way up here. So you look at the lowest low of the last red candle, in this case black, but red candle, down candle. You take that low all the way to the next red candle you see, and you find the high of that one. So where the two thin red lines are drawn, in between that, in the shaded area, is the gap. The reason for that, like I said on the previous slide, is if you have inefficiency, it means the market is not going up and down in a waveform retesting. It's going all the way up or all the way down. So the reason you draw from the two opposite candles to the trend is because the period in between, the area in between, can be considered a gap as there is no retest. So from candle to candle, opposite trend. So find an uptrend, find your most recent red candle at the top of it, then go back to the start of the trend and find your most recent red candle right before the trend started. Draw the area between the two, that is your gap. Now a fair value gap, FVG, is very specific to an impulse move. So I've drawn one here, and that is when you find an impulse candle. So generally you want to find a strong candle that moves in a trend, so a strong up candle in this sense, and then price continues on. From the low of this wick to the high of the wick before, that is your FVG. It is the untested point between two wicks, either side of an impulse candle. So you have an impulse candle. The very nature of an impulse candle is inefficient because it moves very far in one direction with no pullback. In the candle before that, there will have been an upper wick, and in the candle after that, there will generally be a lower wick. You draw the gap between them, and that is your FVG. If it seems confusing now, don't worry. Over time, once your eyes adjust to it, you will see them very easily. If you look at it from this perspective, right before the impulse, we tested this level. So we know that level was already tested. Then we broke through it, and in the very next candle, we tested down as far as this level. So where the two red lines are, everything in between that has been untested since the impulse. That's all that matters. Same with the overall gap as the FVG. You're trying to find areas that have not been retested yet, because when price returns back to them, it can offer high probability trades on the first retest. So how should we trade them? Well, to trade a gap, you first want to allow the gap to form. So the gap will form with a series of candles in the same direction with no bounce. Second, you want to wait for a trend reversal. And third, you want to use the gap as a target for your take profit or entry for a continuation or reversal play. Let's break that down a little more. So 1, your gap forms. So you can see the gap forming here, and I've drawn both an FVG and a regular gap. Remember now, so we are in a downtrend, so that means the black candles are red. And so you remember the rule from before, you want to find the lowest last green candle, which is this candle here, the low of that to the next green candle, which is here, and the high of that. And the point between the two is your gap. Everything in between that is red candles, down candles. And so in between them is a gap. Your FVG, which is generally a bit more precise and within the other gap, is everything from the low of this candle to the high of this candle. Because your impulse candle leaves an FVG from here to here where the wicks are. You have a wick, and the space in between is an FVG. Now to begin with, you just allow that to happen. You don't do anything with that information because the trend is very much down. But when you see a high probability reversal, like we have here, where there's a swing high, price breaks above it, confirming a reversal, you then know where your highest probability target is. So if you want to enter longs and you have a setup per your system, you know that if you're entering longs on the way up, that your target should be somewhere towards the top of the gaps. And you can see that right on the wick of this candle, it hits both the top of the gap, which is the bottom red line, and the top of the FVG, which is the top red line. That is where you would exit longs if you were long on this move, or where you would enter shorts if you want a continuation play, because the trend is still down. Filling the gap is generally a continuation move, meaning if it trended down, then bounced up into the gap, it generally will move down again after. They're usually continuation. So that is gaps, the different definitions for them, and also what FVG, fair value gap, means. And in the next lessons, I will talk about how to frame your bias towards gaps based on different time frames, as well as some more information on how to trade them.